Hello there. Now that we've learned about the Modigliani-Miller's assumptions and the setup, we're in a good position to dig deeper into their first theorem, which is the capital structure under zero tax policy. So let's get to this. The conventional wisdom prior to 1958 was that leverage is good because it increases the value of the firm and decreases the weighted average cost of capital for the firm. But since they were teaching this topic of the capital structure, they weren't happy with the existing literature. So they decided to come up with their own theory of the capital structure. And they start with the most basic case where we have zero taxes. And they show that firm's value is unaffected by the capital structure or the leverage of the firm. But keep in mind, they did this under a set of restrictive assumptions. So in their proposition 1, which deals with the value of the firm, they prove that if the total cash flow to investors of unlevered firm and the levered firm are equal, then the arbitrage is possible unless the two firms have the same value. In other words, they find that capital structure is irrelevant. So let's look at this argument for the cash flows. If you look at an all equity firm, let's just do this, all equity firm, the cash flow from owning an unlevered firm's stock when we have no taxes and no interest payment because they don't have any debt, and since the growth rate is zero, so we don't really have any retained earnings, we just pay out everything to shareholders, no further investment in assets. So we pay all the cash flows, which is going to be your EBIT, to the shareholders. In case of a levered firm, where the cost of debt is the interest RD, and then the amount of the cash flow to the debt holders is going to be RD times debt, and the cash flow to shareholders is going to be the difference of EBIT minus the cash flow to the bondholders. So the total cash flow to providers of capital in a levered firm is going to be cash flow to debt holders, RD times debt. This is the total interest that you pay on this loan, plus the cash flow to shareholders, EBIT minus RD times debt. So these two will cancel each other out, and then you end up with the same cash flow to the providers of the capital. Here, the providers of the capital are just shareholders. Here, the providers of the capital are bondholders and shareholders. But the cash flows that we pay to the providers of the capital are going to be the same. That means that the value of the unlevered firm should be the same as the value of the levered firm. Otherwise, there would be arbitrage opportunities in this case. So homemade leverage can be substituted for corporate leverage. In other words, firms cannot do anything for the investors that they can do for themselves. And proposition 1 deals with the valuation of the firm and shows that value of the levered firm is the same as the value of the unlevered firm. In other words, capital structure is irrelevant in a world with no taxes. And again, the size of the pie doesn't depend on how you slice the pie. Doesn't depend on whether you use debt and equity or just equity. The size remains the same. And in proposition 2, we're dealing with the cost of capital of the firm. Because the free cash flows of the levered and unlevered firm are the same, their weighted average cost of capital should be the same too. In other words, we know that the value of the levered equals the value of the unlevered. So the value of the levered is the free cash flows of the levered over 1 plus the cost of capital of the levered. And value of the unlevered is free cash flows of the unlevered over 1 plus the cost of capital of the unlevered. So if the free cash flows are the same, the cost of capital of the two should also be the same. So weighted average cost of capital of the firm is independent of the capital structure employed. As leverage increases, which means that we use more of the cheaper debt, why don't we see the weighted average cost of capital going down? Why is it going to stay the same, like in this case? In a world with no taxes, cost of equity capital moves linearly with leverage. So let's see what does it mean. In a world with no taxes, weighted average cost of capital can be calculated like this. Weight of equity times the return in equity, weight of debt times the return in debt. So here are the equations for proposition 2. In proposition 2, we're saying that weighted average cost of capital of the levered firm is the same as the weighted average cost of capital of the unlevered firm. So here is the formula for the weighted average cost of capital, which is the weight of equity times the cost of equity, weight of debt times the cost of debt. But if you remember from the original weighted average cost of capital formula, we had a term 1 minus tax rate here. But if we have 0 taxes, this will be 1, so we can just get rid of the whole thing. So as if this was never here. So the weighted average cost of capital of the firm is the weight of equity times the cost of equity and weight of debt times the cost of debt. Keep in mind that for an unlevered firm, this would be 0 and this would be 1, which means that for an unlevered firm, the cost of capital equals the cost of equity equals RA, which is the cost of the firm's business risk. So if you're an all equity firm, your cost of capital is the same as your cost of equity, is the same as the cost of the firm's business risk. But if you have debt, then we change this. As you keep increasing debt, in other words, as you keep raising the debt to equity ratio, that means that the cost of equity should increase as well. Remember, when you change your capital structure, the original equity holders had 4 units of risk, but when you keep increasing debt, you keep adding additional units of risk to the equity holders of the firm. The higher the risk for the equity holders, the higher the expected return for those equity holders as well. So we call the first part of this, RA, is the cost of business risk, and the second part, that additional unit of risk, this additional unit of risk is the financial risk. This additional unit of risk is only there because you added debt to your capital structure, right? Graphically, we can look at proposition 2 formula here. As you can see, the cost of capital of the firm is unchanged. Regardless of your debt to equity ratio, whether you have 0, right, or you have 50% debt to equity ratio or whatever, you see that the weighted average cost of capital of the firm stays, right? We're assuming that cost of debt also stays the same. But as you keep adding debt to your capital structure, as you raise your debt to equity ratio, you'll see that the cost of equity is linearly, right? Because of this term, because you're adding debt to your capital structure, because you're increasing this ratio, you're going to see a linear rise in the cost of equity or expected rate of equity of it. But why doesn't the weighted average cost of capital of the firm goes up? The reason is that the change in the capital structure weights is exactly offset the change in the cost of equity. In other words, when you keep increasing your debt to equity, right, That means that you're increasing this part, the weight of debt goes up, right? Weight of equity goes right. So this change in the weight of the equity and debt will offset the increase in the cost of equity for the right. And that's why you're going to end up with a constant weighted average cost of capital for the firm when we have zero, right? So let's look at an example here. Here we have a Bowling Green firm with a weighted average cost of capital of 12%, ignoring taxes. Their cost of borrowing is 8%. And if the target capital structure is 20% debt, 80% equity, what is their current cost of equity? So current cost of equity can be calculated by the formula. The cost of equity is RA plus RA minus RD times debt to equity ratio. So we will have 12%, which is the 12% weighted average cost of capital plus 12 minus 8% cost of debt, and then 20% over 80%. So this should give you 13% cost of equity for the firm when they have 20% debt, 80%, okay? Now we want to change the capital structure to 50% debt and 50% equity. So in this case, the cost of equity would have 12% plus 12 minus 8 times 50% debt, 50% equity. So this will give you 16% cost of equity when you raise your debt, when you increase the proportion of debt in the capital structure. Now we want to confirm proposition 2 of the Modigliani-Miller, right? By calculating the weighted average cost of capital for both, right? So in the first case, when we have 20% debt and 80% equity, weighted average cost of capital was equity over value times cost of equity, debt over total value times cost of debt. So we'll have 80% times this 13% cost of equity plus 20% times 8% interest on the loan. So we should be getting 12%. And in the second case, your weighted average cost of capital would be 50% times 16 plus 50% times 8, which is going to be that 12%. So as you can see, the weighted average cost of capital of the firm when we have zero taxes doesn't really, right? Regardless of your mix of debt and equity that you have, whether 20% to 80% or 50% to 50%, your cost of capital is going to remain the same in this case. I hope you find this video useful, and thanks for watching.